Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and we're doing our housing weekly market update. Our Phoenix hot sheet is starting right now. Hope everybody's doing well. Well, let's take a look at what's happening in the housing market, and we'll make it make sense for you. So, Logan Motoshami, back when this whole conflict with Iran started with Housing Wire, came out and said, that poised for growth in 2026 if the Iran conflict doesn't raise rates. Mortgage purchase application has been positive year over year, every week, and Housing Wire weekly pending sales has remained positive. Well, we know that this conflict has been going on longer than anybody wants, and I I think it was something that definitely needed to be done, but I don't want to get into all the political stuff here, but um, everybody wants it over with sooner than later, and and hopefully we can get a good deal without anybody else, without any other casualties. So here we go. Here's a quick rundown on what's going on and kind of bottom line this for you, and then I'll get into the details. Housing demand nationally is still holding up better than expected, despite mortgage rates climbing back near 6.7 to 7%. Now, we'll get into what they were today, and we actually saw some of a drop. Um, and we'll get into some of the details of that. But always keep in mind when I'm quoting these rates, these are national rates. Whatever we are at, we are going to be able to get our clients just out of the gate without doing any buy down rates or anything like that, about 100 basis points lower than what's being said here, without even getting into any negotiating or buying down rates. But pending home sales are improving year over year. Affordability is slowly getting better because wages are outpacing home prices and inventory is moving back toward healthier balance. Obviously, that's going to take some time with all the crazy inflation that we had in the past. And once that inflation goes up, we got to kind of distinguish the difference between the fact that we once that inflation went up like it did, back 4 or 5 years ago, we have to look at, okay, that went up, and usually that kind of stuff is not coming back down. So it's the rate of inflation moving forward that we want to keep an eye on. So we've got to really make sure we clarify that, because people think when we talk about inflation, at some point we're going to have prices go down. We're at a whole new level and they're not going down. Okay. For the most part, there may be certain things like eventually oil prices come back down and we're up because of we're tied in with the global markets, even though we don't get oil from over there and all that sort of thing. And we're the, greatest supplier of energy and oil and natural gas and all those things, but we're tied in with the global markets. And but once we get to that other level, the inflation does not come back down, but it's the rate of inflation moving forward and how that's going to be climbing. So let's make sure we clarify that. The market is not booming, but it is stabilizing with modest growth instead of crashing. What I'm calling this year is a reset year. We're in a reset year for housing and the mortgage industry. So things are definitely getting better. Rates definitely are lower than they were, but it's not going to be like this crazy takeoff year. So we'll get into this more as we go. Biggest risk right now is higher mortgage rates tied to inflation concerns, oil prices, and the Middle East conflict pressured on the bond market. The bond market, because that 10-year treasury ends up setting our 30-year mortgage rate. Nationwide real estate contract cancellations are hovering near multi-year highs, with roughly 1 in 7, or over 13%, of signed home purchase agreements falling through. Buyers are increasingly backing out due to severe affordability constraints, changing their minds after reluctantly, looking at mortgage costs or leveraging structural issues found during inspection to walk away. In the greater Phoenix area, a bottom line for you would be the Phoenix market remains relatively balanced to slightly seller leaning overall, with about a 4-month supply of inventory. But conditions vary heavily by city and neighborhood. Inventory growth has slowed slightly week over week, but buyer activity is still stronger than the last 2 years. Homes are taking around 75 to 77 days to sell, actually close out. Price negotiations remain normal, around 2 to 3%, and sellers who price correctly are still moving homes. That's very important right there. Very important to have a pricing strategy. There's a lot of aspirational pricing going on, so we got to be real careful about that. Mortgage rates remain the biggest headwind, but Phoenix demand is holding steadier than many expected. For May of 2026, the greater Phoenix area real estate market is seeing an elevated number of contract fall throughs with cancellations, rates hovering around 16% cancellations. So buyers hold increased negotiation power in this shifting higher interest rate environment during this conflict, increasingly utilizing inspection contingencies, due diligence period to walk away or renegotiate concessions. This is a common occurrence, okay? Along with your usual concession. So I just wanted to kind of frame everything up with that and kind of give you a quick overview and then get into some of the details here. So here we go. Meta layoffs starting this week stress harsh AI reality inside Zuckerberg's company. I know a lot of people may not care about this, but when it comes to AI layoffs, jobs numbers, of course, the Federal Reserve looks at whether we have full employment and what the inflation rate is doing, and they've been looking at the labor over inflation even as a higher call point or metric point for them to be setting their course on what their policy is going to be. So Meta is slated to start its layoffs, our latest round of layoffs this week with a total of 8,000 projected job cuts. And obviously, people are contributing to this to, AI. And obviously, if somebody's losing let's say, just using around an $80,000-$90,000 job, they go get unemployment, $300, $400, $500 a week, whatever it is. It's going to probably be hard to make ends meet. More layoffs are expected this year, including a potential round in August and another in fall, according to people with knowledge of the matter. Meta CEO Zuckerberg has changed his tone dramatically when it comes to layoffs since the company implemented widespread cuts starting in late 2022 after the COVID boom. So they're just, again, one of many indicators of what's going on in the jobs market. I'll talk more about that in just a second. If we look at this cautious optimism, U.S. pending home sales rise for the third straight month in April. Okay. Now, we talk about leading indicators a lot, purchase application data, properties going under contract. We track that every week. And we saw that those numbers were looking good. We've got, let's see, I'll tell you exactly what we have right here. Purchase application data, has been positive a year over year. It was at 21%. Now, just in the past week, purchase application data update minus 4% week to week, and it's plus 8% year over year. Nothing, Logan Montashami says nothing too dramatic in the demand side yet with higher rates, but he says this is really weak one of rates being over that 6.64%. If rates had higher, as they have in the past, he says, it has slowed down activity. Okay, so just something to be aware of. And the other thing is, with the mortgage spreads between the 10-year Treasury, that's important, which I'll talk about more here just in a second. But a lot of this was kind of the tailwind up until the Iran thing started. And now, since it's gone on longer than people hoped, I would say, we already had our marker at the end of April where things were going to get tight. We're kind of hitting that now, where it's going to really be affecting the economy, jobs market, affecting things like, housing. and we could be heading into that. If this thing isn't wrapped up by mid-June, we're going to really see some really hard impacts to the economy. We're going to probably see issues for the midterms, and all those sorts of things. So just something to think about. Hopefully, it's all over by then. Builders builder sentiment. Why is this? Let me get this out of the way. Okay, builder sentiment for the builders, new home builders. Um, Key findings for present sales of new single-family homes expected, over the next 6 months. Traffic of buyers of the single-family homes. Key findings. So they kind of do this metric between 0 to 100. Okay, real easy. Anything higher over 50 is an indicator that builders feel confident. So right now, builder confidence in the market as of this week for newly built single family homes increased 3 points up from 34 to 37 in May. So it's going up, but it's still below that 50 mark. And here are readings for the three indicators that they're looking at. Current sales condition um, rose 3 points to 40. Sales expectations over the next 6 months increased to 45, was at 42. And traffic of prospective buyers posted a 3 point gain to 25. So, signs of a cooling market. Latest survey also revealed that 32% of builders cut prices in May, down from 36% in April. The average price reduction was 6%, up from 5% figure in April. The use of sales incentives was 61% in May, up slightly from 60% in April. In making the 14th consecutive month, this share has reached 60% or higher. So, just some concerns there that those numbers are increasing, but still not seeing the confidence that they want. As we stay in this Iran conflict, we could see those numbers cool off, but they are not emotional about things. It's all about business. We mentioned it last week. We saw some big price reductions, as it mentioned there in new home sales. They're also offering all kinds of incentives. You can get the lower interest rates. I've seen as low as 2%, 3, 4%. They're paying for closing costs, appliance packages, all that sort of thing. So just something to keep in mind if you're thinking about buying a home. You might want to look at a brand new home and see what incentives you can get and kind of compare it with the resale market, especially when it comes to location, which can be, more important for some people than others. So looking at the stats, we've got, you know, increase um, in the inflation rate. And there's also a, weakening, signs of weakening in the jobs numbers. So it's kind of a competing thing for the Fed to look at because they want full employment. They want that 2% mark that somebody came up with in New Zealand. Up to this point, they want that 2% target point. So persistent inflation supports keeping rates higher for longer, while weaker employment data could strengthen the case for rate cuts later this year. So even though we've had some, increased readings, the last two or three readings on the overall labor data, we see, some issues in the labor market still that we've been pointing out. So we'll kind of have to keep an eye on that, see what the Fed does. The next time the Fed meets is June 16th and 17th with the new Fed chair, Kevin Warsh. So thankfully he's in there. But if we see these rising tensions, heat up at all, we could. They're saying we could possibly see a 25 basis point rate hike in the Fed rate. It just depends on how things go, and hopefully this thing gets negotiated, uh, you know, sooner rather than later when it comes to this conflict. All right. So, why am I having trouble with this? Okay. So, let's see if we can get, there we go. All right. So, The other thing to take a look at is the how much, Logan Moshami put this out. How much higher can mortgage rates go? In a nutshell, with spreads near 1.92% between the 10-year treasury and the 30-year mortgage, most rate damage uh, may be in other words, baked into the bond market already, unless oil driven inflation persists and the Fed turns more hawkish. That combination could raise mortgage rates above 6.75%. Okay, so this is what we need to keep an eye on. Hopefully, you know, we got to really hope that we don't see anything like that happening. That would be really bad. But mortgage rates are at I'm sorry, at yearly highs, but housing demand still above positive for now. Depends on how much this thing drags out. But it says mortgage spreads fell 1 to 1.25% as the 10-year treasury rose to 4.596. So keep those numbers in mind when we look at the 10-year treasury and the mortgage rates after a sell-off tied to Iran conflict and oil risks. At prior peak spreads, meaning the last few years, where the spreads weren't quite as good between the 10-year treasury and the 30-year, we would have interest rates over the last 2 and 3 years, 7.27% to 7.84%, while current housing demand indicators remain slightly positive. Slightly positive. Okay. So the way Lawrence Yun put it over at the National Association of Realtors, their chief economist, he said buyers are coming out with cautious optimism despite increasing economic uncertainty and a slight rise in mortgage rates. Demand will easily be even higher once mortgage rates retreat to the levels they were at earlier this year. Once this, if this Iran thing ever gets, cleared up, we're going to see oil prices drop. That's kind of the back end of everything, for energy and petroleum products. Think about how many plastic stuff, how much plastic we have to deal with in our lives. Once that happens, we're going to see oil prices drop. Everything, 10-year treasury will drop, mortgage rates will drop back to where they were earlier this year. So that's basically his point, which we've been talking about as we've been going along here. So, I actually want to hold this for later. Okay. So shelter costs, we've talked about this many times. This is why, we always say that the Fed has been behind the curve, because we can see the last 2, even 3 years, the shelter costs have been going down. That makes up a third of inflation. That's why I always say, Logan Moshami, Barry Habib, they've been saying that the Fed is looking at old, outdated data. We need to get caught up. We need to look at real-time data, something more like a trueflation real-time data. What the Fed looks at is about 80,000 different data points. What trueflation looks at is like 10 million data points. But this shelter cost making up about a third of that overall inflation metric, it really shows you, how much we have dropped. And if we even go back further, we can see that slope just drop right off, right around here. It just starts dropping off right around the first and second quarter of 2023. So that's why we always say that the Fed is behind. So we'll see how that goes with the new Fed chairman. Obviously, he's not the only one that votes, but we'll see what the messaging is in June, which is actually more important on what kind of a stance they're taking. So over the last week, here's where our crude oil has been going, and this is what it's been doing in the last day. Just today, though, it's dropped off. So there's been talk of ceasefire, and we're getting close to a deal. So things kind of dropped off a little bit. Looking at the 10-year Treasury, hey, 4.5. That means normally we would be somewhere around 4.3. Okay, the 4.4 ish, somewhere in there. I'm sorry. not we should be, right around on our mortgage rate, we should be right around 6.5 or lower on the 30-year mortgage if we're at 4.5. And we could see how with the oil, this kind of dropped off also in the last day, uh, just today, how this has dropped off pretty much in correlation with those oil prices. Looking at the 30-year fixed, it's right above that benchmark where we like to see it, where it's less than, right around between 1.6 to 1.8 from where that 10-year treasury is. So this reading here should be, if we were back in real times, about 20 or 30 basis point lower than it is right now, at least. So it is what it is. Looking at this though, if you want to know, well, can I get a lower mortgage rate though? This is just the average across the country. Yes, you can. Mortgage broker, we have a great one. His name's Andrew Fisher with Simplify Home Loans. He can get you something that look like 100 basis point lower than this 30-year conventional. Same thing goes for FHA or VA. So whatever you're seeing here, think 100 basis points lower. I'm going to call Chris and Andrew, get that all set up, and we get you going. Okay. Um, so looking at mortgage applications, they've dropped off. That's a leading indicator in the next 30 to 60 days. They dropped off a little bit. So we'll see. Hopefully they recover. Uh, the housing inventory has gone flatlined as far as where we were over the past, few months. And what we're going to see is this is actually could go to negative. It was only up, you know, maybe about 1%, a little over 1%. So we're going to see how that works out, because if that drops off, then obviously we do have some backstop to that because of the extra inventory we had over the last year. But we'll see how that goes. Jobless claims have gone up a little bit. Nothing for any great alarms at 211. Nothing crazy for the Fed to be looking at. Um, New listings, again, those have tapered off a little bit. The greatest home selling season, as we mentioned in the past, was right around mid-April, to get your property out there on the market. If you wanted the quickest sale, if you wanted the most offers, if you wanted the highest price, we're still in, the selling season for sure, but that would have been the best time according to all the data to do that. Usually our selling season is going to be right around that, getting into March, into June. We usually like people to actually start a little bit earlier, kind of get ahead of the curve, kind of get ahead of the competition. Uh, but usually people run in those cycles because of school and work and things like that. So home price reductions, um, they have actually gone a little bit elevated, and then they kind of dropped off a little bit. So we'll see how that goes compared to some of these other years. So we'll keep an eye on that as we go along. And then pending home sales, right now we're at 430. We were hoping that was going to be a little bit higher, but not totally horrible at this point. So we'll see. Right now, all the four regions, when you look at the West, the South, the Northeast, the Midwest, they're all up as far as pending sales go. It's just the southern states are doing the worst, and kind of a little bit of a negative there. But all the other regions are up. Nothing crazy, but they're up. They're up a little bit. So looking at some of this data for Phoenix, getting into Phoenix now. I don't know why this thing is bigger than I want it, but I'm going to kind of get it off to the side here. Okay. We're at 77 days closed down market and about a 4-month supply. So right now we're kind of teetering on going into a mild seller's market, absorption rate at 24.88%, 781,000 average list price, 634,000 average sales price, and list to sales price ratios right at 97%. So sellers are giving up about 3%. 2 to 3% is pretty normal, so nothing crazy there. We usually like to see this right around 97.8, but nothing really too out of line there. Zero inventory as far as increased inventory. Pending sales are down. Again, leading indicator. They go under contract. Usually takes about 30 days or so to get those closed out. But our pending sales last week was up, and we saw that started showing up in the week over week closed units. It was been up over the last 2 or 3 weeks. So that's showing up now in the closed units, up 38.7%. Makes sense, right? Peak selling season, April, May, kind of the heart of it. Boom. All right. So um, looking at the next chart here, let me just pull this up. So this is where we kind of dig into the data a little bit more. These are all ROTs or rule of thumbs over here on the left. 2,400 a week is usually like what we like to see. Week over week, we're down 13.6% on the new listings overall. And it's 2,142 homes have listed. The week prior was 2,479. So we have a drop off there, down 13.6%. And again, we usually like to see 2,400. Where we were last year, we're up from that where we were last year and the year before. So that's good news. Getting more inventory, more choices for buyers. Distress sales, nothing crazy going on there. Nothing to get our panties in a ruffle there. But we had about 300 homes short sale, 145 lender owned REOs. The pending sales or homes under contract, again, usually like to see about 5,500 a week. We were at 4,709, down a little bit from the week prior, but up year over year and up to the prior year. So we definitely have more buyers in the market. It's just dropped off a little bit in the last week. Again, elevated rates, all the conflict, higher inflation kind of plays into all that, right, guys? A lot of people trying to time the market, which, not really a thing I would recommend doing, because the sooner you get in, the sooner you can start, gaining that equity and get moved on with things. But 98.1% would be kind of where we would want to be with non-distressed. And closing is at 138.7%. So our closings for this week, we had 3,617. The week prior, we only had 1,515. Okay, we are in the peak, in the heart of the selling season. The year before, we were actually off a hair, just about 70 homes, but down just a little bit from last year and down a little bit from the year before, same week. Okay. Rule of thumb, we usually like to have 2.5 to 3 months supply of homes. And right now we're at 4 month supply. The week prior, we were at 3.38. So we had a little bit of a tick up there in the month supply, but we're definitely down from the year prior and above the year prior to that, 2024. So 70 days closed on market. We were at 92. I'm sorry, we were at 77. We like to be at 70. We were at 77. The week prior, we were at 75, and the week before that, the year before that, 74, and the year before that, 69. So again, we're kind of near that normal range, but up a couple of days on market from the week before and the year before. Okay, so right now, I would say it's kind of a normal market, nothing to get too crazy about, nothing out of the ordinary there. But I got some questions this week from people who were asking, how are sales doing? Are they going up? What do you expect them to do this year? All that sort of thing. So here's a chart where we had closings Year to date for 2026, 26,205. That's up 3.9% as far as the number of closed sales. Total sales volume is up year over year. Okay. Just as the closed units are 3.9%. Uh, and then the overall for sales volume is up just over 7%. The median sales price, this was interesting because a lot of people say it doesn't seem like prices are going up. Median kind of gives you more of that mid range, that mid feel, that mid idea of what the middle number of what's going on in the market. And it's right at 0%, which kind of gives you, I think, that idea out there because there are certain areas of town, certain communities, little local hyper local communities that will sell super fast, certain parts of town. But overall, it kind of has that stagnation feel, which gives us that idea of 0% for the median sales price. But the average sales price is actually up 3%, just over 3%. So, you know, a normal market for us in the greater Phoenix area for home price appreciation is going to be right around 4 to 5%, let's say 4.5% historically going back to the 80s. So, we're a little bit below that market when we're at 3%. I think, if this, again, a lot's hinging on, how long this Iran thing's going to take. But if that thing gets over with and everything drops, like we're talking about as far as, oil and inflation rate and the 10-year treasury and mortgage rates, we could see a little bit of an extra surge in the, third and fourth quarter here, end of the second quarter. So we'll just kind of have to see how that all plays out. Well, actually, we're almost at the end. We are at the end of the second quarter. So going into the third and fourth quarter. So we'll have to keep an eye on that, guys. So anyways, I just thought that would help to kind of point those numbers out. According to Cromford, our local real estate gurus here that pull everything from the MLS, they kind of take into consideration not just the contract ratios, but also their algorithm and what's going on in the overall sentiment of the market. They're saying we're at 81.9. So basically, let's say 82 for a round number. Anything below, or anything between 90 to 110 is kind of in a balanced range, 100 being totally balanced. We're at 81, we're in a buyer's market. Anything below 90 is considered a buyer's market. Anything above 110 is considered a seller's market. I can tell you right now, if properties present well and they're priced accordingly, we are seeing them go under contract very quickly. We're seeing them get multiple offers, but they have to present well and they have to, you know, uh, be priced accordingly. And they have to be not only priced accordingly to the value, but priced accordingly to the way people search. I'd love to be able to go through that with you more at a separate time, but it's really important to position your property the right way online, and price it so that people will actually find it. So anyway, without getting into the weeds of that, we're supply is over 100 at 107, so we're up a little over 7% on that, and demand is down from 100 to 88. So that gives us 12% lower than we would want to see for a balanced market if we take those two numbers into consideration. So there is a thing called the contract ratio. So all the properties that are under contract compared to the properties that are listed for sale right now on the contract ratio chart, this gives us more of what's happening now. And we're at 38, which gives us anything over 30 is considered a warm market, kind of a balance range, nothing too exciting happening. And then if we look at the heat map that coincides with that on a map for properties listed, properties under contract in a particular zip code. We've got a couple of zip codes in Chandler, actually two in Chandler, one in Tempe. Let's see, Phoenix 85028, Phoenix 85024, Glendale 85303, and we got another area, Phoenix here and here. Everything else is kind of just warm, and then there's certain areas in the middle of Phoenix and Scottsdale that are in a cold range. So kind of a very, you know, kind of a normal balance, but yet boring market right now. Again, I would look at this as more of a reset year for what to expect with mortgage rates and what to expect with the housing market. As soon as this Iran thing is done, though, we're going to see everything drop down. So, guys, if you have questions at all, want to know about the value of your home, what we would do to get the property sold, want to know how that breaks down, what you'd actually walk away with all the costs, title and escrow fees, professional fees, all that sort of thing, how that all breaks down. Um, and even if you're not ready to sell right now, at least you've got that information. And then moving forward, we can keep you updated on your home's value, especially after we've seen it. Just trying to do it behind a computer screen doesn't really give us the best idea. Even an appraiser who's going to appraise your home needs to come to your house and take a look at it to get you, the right appraisal. And even then, they take a few days, sometimes or a couple days or a few days to get you that report. So it's really important that as agents, we're able to take a look at what's going on in your home if you want a true value and a pricing strategy. And then we can go through all that, how it breaks down and what we would do to get the property sold. So, guys, we will see you next time. Home buyers, keep in mind, we not only have great, better rates than you're going to see out there, but we're also able to negotiate your buy down rates and that sort of thing, which is even better than a price reduction when it comes to your monthly payment. But we have in down payment assistance programs and all that. But even if you're using a conventional FHA, VA loan, we've got this grant we've been talking about. It's a $10,000 grant. You can use it towards paying down your credit cards, paying down your car loan. Maybe that'll help you get a higher or get you qualified or help you get a higher credit score to qualify for better terms. You can use that towards your down payment, your closing costs, to buy down your rate. So, in a lot of cases, we're seeing where, somebody gets, in with our mortgage broker and they've got, rates that are like 1% lower than what you're seeing on TV and on these average rates across the country. And then you throw in this grant with it, which is truly, free money. You throw this grant in there with it. And now, if you wanted to buy down your rate, you can do that, maybe get another 100 basis points off, get your closing costs paid for. Some people can't qualify because maybe they have some debt that they need to get paid off in order to get, the score they need or want. This is a great way to do that. You pay off that debt and move on with your home purchase. So, guys, feel free to reach out with any questions. We'll talk to you next time. Thank you.